Have you ever wondered why pricing is so crucial in non-life insurance? Well, let's unpack that thought and delve into the fascinating world of insurance pricing. It's not just about slapping a price tag on a policy, there's much more to it. In the realm of non-life insurance, pricing is more than just a number. It's a strategic tool that can make or break an insurance company. It's the beating heart of the insurance business, pumping the lifeblood of profitability and competitiveness through the company's veins. Imagine an insurance company as a large ship sailing in the vast ocean of the market. The price is the compass guiding the ship, ensuring it doesn't veer off course. Set it too high and the ship may find itself lost in the sea, unable to attract customers. Set it too low and the ship might start sinking under the weight of claims that it can't cover. So it's all about finding the right balance, the sweet spot that attracts customers and keeps the company afloat. But how does pricing impact profitability? Well, it's simple. The price of an insurance policy is essentially the premium that a customer pays. This premium is the primary source of revenue for an insurance company. If the pricing is right, the company can cover all its costs, including claims, and still make a profit. But if the pricing is off, the expenses might outweigh the revenues, leading to losses. And what about competitiveness? In the fiercely competitive insurance market, pricing is a powerful tool to attract and retain customers. A company that offers a good cover at a competitive price is likely to stand out from the crowd and win customers' hearts. But a company that prices its policies too high may find itself in the shadows, struggling to compete. So, pricing is more than just a number. It is a strategic tool that drives the success of an insurance company. It's the compass that guides the company's journey in the vast ocean of the market, ensuring it stays on course and reaches its destination, profitability and competitiveness. But how exactly do insurance companies determine these prices? Well, the process is a bit more complex than simply pulling numbers out of thin air. Non-life insurance pricing is a delicate dance that involves a variety of components, each as crucial as the next. First and foremost, we have the risk assessment. This is the heart and soul of insurance pricing. Insurers assess the risk associated with insuring an individual or an asset. For instance, if you're insuring a house in an area prone to natural disasters, the risk is higher. Thus, the insurance premium will also be higher. It's a simple principle. The greater the risk, the higher the cost. Next, we have claim frequency. This refers to how often an insured entity makes a claim. If you have a history of making frequent claims, insurers will consider you a higher risk. This will, in turn, increase your premium. On the other hand, if you've never made a claim, you're seen as a lower risk, leading to a lower premium. Then, there's claim severity. This measures the financial impact of a claim. Let's say you have a car insurance policy and you get into an accident. If the damage to the car is severe, requiring extensive repairs, the claim severity is high. This could potentially influence your future premiums, but it's not just about assessing risk. Insurers also have to factor in their own costs, administrative expenses, marketing costs, and profit margins. They need to ensure that the premium covers not only the potential risk, but also their operational costs. Lastly, regulatory factors come into play. Insurance companies operate within a regulatory framework that dictates certain pricing practices. These regulations aim to protect consumers from exorbitant pricing and ensure fair competition among insurers. As you can see, pricing is a delicate balance between risk and reward. Insurance companies need to price their policies in a way that covers potential claims, their costs, and allows them a fair profit, all while adhering to regulatory guidelines. It's a complex process, but one that's fundamental to the operation of the insurance industry. Now let's delve into the complex mathematics behind non-life insurance pricing. The mathematics of insurance pricing is a fascinating blend of probability, statistics, and actuarial science. Let's take a moment to unpack these concepts and understand how they shape the cost of your insurance policy. First off, probability. In essence, probability is the science of uncertainty. It's all about measuring the likelihood of an event occurring. For example, a car accident or a house fire. Insurers use probability to assess the risk associated with a potential policyholder. If the probability of a claim is high, the premium, that's the price you pay for your policy, will be higher too. Next, statistics. This is the discipline that helps insurers make sense of large amounts of data. It's all about identifying patterns and making predictions. For instance, they might use statistics to find out that people in a certain age group are more likely to have car accidents, or that homes in a particular area are more prone to flooding. These insights help insurers set premiums that accurately reflect the risk involved. Now on to actuarial science. This is where things get really interesting. Actuarial science is all about using mathematical and statistical methods to assess risk in finance and insurance. Actuaries are the professionals who do this work. They use complex mathematical models to predict future claims and to ensure that the premiums collected will be enough to pay those claims, while also ensuring the company remains profitable. One key tool actuaries use is the loss distribution. This is a mathematical model that predicts the size and frequency of future claims. Imagine a graph where the x-axis represents the size of a claim and the y-axis represents the probability of that claim occurring. The shape of the curve tells the actuary a lot about the risk they're dealing with. Another crucial concept in actuarial science is the law of large numbers. This principle states that as the number of independent risk units increases, the actual loss will more closely approximate the expected loss. In simpler terms, the more policies an insurer underwrites, the more predictable their payouts become. This predictability helps insurers set premiums that are both fair and sufficient to cover future claims. And let's not forget about discounting. This is a technique used to determine the present value of future cash flows. In the context of insurance, discounting is used to calculate the present value of future claim payments. This helps insurers ensure they have enough reserves to cover these future obligations. So while the math may seem daunting, it's all about predicting risk and setting a fair price. But what specific factors do insurance companies consider when setting prices? Let's dive into this interesting realm. One of the primary factors influencing the pricing of non-life insurance policies is the type of coverage. For instance, a policy covering a beachfront property is likely to cost more than a policy for a comparable inland property. This is due to the increased risk of damage from natural disasters such as hurricanes or floods that are more common in coastal areas. In the same vein, a policy covering a luxury sports car is likely to be priced higher than a policy covering a family minivan. The sports car not only costs more to replace if it's damaged or stolen, but it's also statistically more likely to be involved in a high-speed accident. Another crucial factor is the insured's characteristics. These can include age, gender, occupation, and even marital status. For instance, younger drivers are often charged higher premiums because they're considered more likely to be involved in accidents. Similarly, people in occupations that involve a lot of travel or risk, such as construction workers or professional drivers, may also face higher premiums. Your past claim history also plays a significant role. Insurers look at how many claims you've made in the past and the nature of those claims. If you've made several claims or if you've made a claim for a significant amount, insurers may see you as a higher risk, which could result in higher premiums. Insurers also consider your credit history. This might seem unrelated, but studies have shown a correlation between a person's financial management skills and their likelihood of filing an insurance claim. Those with poor credit history may face higher premiums. Geographical location is another factor. For instance, if you live in an area with high crime rates, you may pay more for your car or home insurance due to the increased risk of theft or vandalism. The condition of the asset being insured can also influence the price of the policy. A house in poor condition or a car with high mileage is likely to attract higher premiums due to the increased likelihood of a claim being made. Lastly, the level of deductible chosen by the insured can also affect the premium. A higher deductible, which is the amount you agree to pay out of pocket before your insurance coverage kicks in, usually results in a lower premium. In essence, insurance companies use a complex algorithm to calculate premiums, taking into account a myriad of factors to accurately assess the risk they're taking on. The common thread among all these factors is risk. The more risk you present, the higher your insurance premiums. So, managing your risk is a great way to keep your insurance premiums in check. In essence, the more risk you present, the higher your insurance premiums. However, pricing is not without its challenges. Let's delve into some of the difficulties that arise in the realm of non-life insurance pricing. One of the greatest challenges is the unpredictability of risk. The entire premise of insurance is predicated on predicting and managing risk, but let's face it, life is full of surprises. From natural disasters to unforeseen accidents, the unpredictable nature of these events makes it difficult to accurately price insurance policies. Actuaries, the mathematicians of the insurance world, use historical data, statistical models, and complex algorithms to estimate future risks. Despite these sophisticated tools, there's always a degree of uncertainty. Another challenge is the ever-changing insurance landscape. As society evolves, so do the risks we face. Think about the rise of cybercrime, the ongoing climate change, or the advent of autonomous vehicles. These emerging risks present a whole new set of challenges in pricing non-life insurance. The question then becomes, how do you price an insurance policy for a risk that has little to no historical data? It's like navigating through uncharted waters where the old maps are of little use. Lastly, let's talk about competition. The insurance market is becoming increasingly competitive. With more players entering the field, insurance companies are under constant pressure to price their policies competitively while still ensuring profitability. This balancing act is no easy feat. It requires a deep understanding of the market, keen business acumen, and a bit of a gambler's nerve. And let's not forget about the regulatory constraints. Insurers must adhere to strict regulations that often limit how much they can charge for certain types of coverage. This adds another layer of complexity to the pricing process. In conclusion, the challenges in non-life insurance pricing are manifold. From the unpredictability of risk, the changing insurance landscape, to the increasing competition in the market, these hurdles make pricing a complex yet fascinating aspect of non-life insurance. As we move forward, the ability to effectively navigate these challenges will be key to the future success of insurance providers. So, what does the future hold for non-life insurance pricing? As we look forward, the future of non-life insurance pricing is likely to be shaped by three key trends: big data, artificial intelligence, and machine learning. Each of these has the potential to revolutionize the way we assess risk and set prices, making the process more accurate, efficient, and fair. Firstly, let's talk about big data. In the past, insurance companies had to rely on a relatively limited set of information to price their policies. They might look at your age, your occupation, your health status, and a few other factors. But in today's digital age, we're swimming in data. Everything from our online shopping habits to our social media posts can be analyzed to build a more accurate picture of our risk profile. This wealth of information, known as big data, could enable insurers to set prices that better reflect our individual risk levels. Next, we have artificial intelligence, or AI. This is a field of computer science that seeks to create machines capable of thinking and learning like humans. In the context of insurance pricing, AI could be used to analyze the vast amounts of data we mentioned earlier. It could spot patterns and correlations that a human analyst might miss, leading to more accurate risk assessments. For example, an AI might notice that people who buy a certain type of car are less likely to make a claim and adjust their premiums accordingly. Lastly, we have machine learning, a subset of AI that focuses on the development of computer systems that can learn from and make decisions based on data. Machine learning algorithms can be trained on historical data to predict future outcomes. In insurance pricing, this could mean using past claims data to predict who is most likely to make a claim in the future. This could lead to more accurate pricing, as premiums would be based on a person's likelihood of making a claim, rather than just their demographic characteristics. But while these trends are exciting, they also pose challenges. For one, the use of big data and AI raises important questions about privacy and discrimination. How do we ensure that our data is being used responsibly, and that we're not being unfairly penalized based on factors outside of our control? And how do we regulate these new technologies to ensure they're being used fairly and ethically? Furthermore, while AI and machine learning can make predictions based on past data, they can't predict the future with absolute certainty. There will always be a degree of uncertainty in insurance pricing, and it's important to remember that even the most sophisticated models are just that, models. They're not infallible, and they need to be used with caution. In the end, the goal remains the same: to accurately price risk and ensure the sustainability of the insurance company. But as we move into the future, we'll need to navigate these new technologies and the challenges they pose with care. Only then can we truly unlock their potential to revolutionize non-life insurance pricing.